We'll give everyone just a few more minutes to get in.
Sounds perfect.
Just one more minute.
Sounds good. I'm not often on time myself. When I'm attending webinars that start at 6 o'clock, I'm rarely on at 6 either, so completely understand.
Okay, it's 6:04. Let's go ahead and get started. I am so excited, and again, I apologize that the last class got messed up. That was entirely on me. Um, but I'm very excited that we all got a chance to come back today and take the Credit Building 101 class. So thank you, Christina, for rescheduling and making it happen.
Thank you all so much for having me. I really appreciate everybody who is here. I know it's 80 degrees and beautiful and a lovely evening, so we really do appreciate your time. As we begin, I do want to let you know that a majority of this training was created in part by Credit Builders Alliance. So we want to make sure that we give them credit where credit is due, and Cash has made some changes and updates to the presentation, but a large portion of the presentation was created by Credit Builders Alliance. My name again is Christina Figueroa. For those of you who weren't here in the previous classes, I am a program associate for financial capability with Cash Campaign. Cash is an acronym which stands for Creating Assets, Savings, and Hope. And that's Cash Campaign of Maryland. Who we are, Cash Campaign of Maryland is a nonprofit organization that promotes economic advancement for low to moderate income individuals and families in Baltimore and Maryland. You can learn more about us by visiting our webpage, which is cashmd.org, cashmd.org. And I will go ahead and add that to the chat for anyone who may be interested in that information. So what we offer, Cash Campaign offers direct service programs. It builds organizational and field capacity, and it leads policy and advocacy initiatives to strengthen family economic stability. Our direct service programs include free tax preparation, financial coaching, benefits screening, Maryland Cash Academy, Bank on Maryland, and financial fitness fairs. For those of you who missed getting your taxes done and are still interested, we have a back tax program. You can find information on our website. Financial coaching program we'll be talking a little bit more about at the end of this class. Maryland Cash Academy has a lot of different financial education programs, free webinars, and some in-person classes. So you may want to look into that if you are interested. And our financial fitness fairs, we had Money Power Day in March, and we'll have a couple of other events going on later on this year. So today we want to make sure that we're maintaining confidentiality. I know that this webinar will be recorded. So if you want to share your own stories, you're welcome to. If you want to have additional questions, just remember that it is being recorded. You may want to not share any kind of identifiable information. So if you have a story that you're telling about someone else, don't provide their names or anything else where we might be able to figure out who they are. Please feel free to ask for clarification when needed. So you can go ahead and add any questions that you may have to the chat. We are going to be covering a lot of material, but I'll do my very best to get to all of your questions. There may be points where I'm going to try to push through a couple slides and then get back to the questions, but I'll definitely do my very best to get to all of your questions. And we want to stay on topic. So if you find that you have some credit related questions that don't really have anything to do with what we're discussing, I think the group would appreciate we hold those questions until we get to a section that may be covering that topic, or you can ask them at the end. There are credit trainings that last literally a week every day from 9 to 5. So there's a lot of material. We're going to cover as much as we can, but we can't cover absolutely everything because there's just so much. So I want to make sure that you all are clear on that. So our objectives for today, we want to, one, understand credit basics, want to learn about credit building products, and we want to discuss strategies that build positive credit history. So for our icebreaker, we don't have too many folks on here today, so you can feel free to unmute yourself or you can add to the chat. What word or words come to mind when you think about credit? Income, okay.
Financial stability.
Financial stability, very good. Thank you.
Worthiness.
Worthiness, yes. Oftentimes you hear the term credit worthiness. Very good. All right, so I'll take that as those are the answers for us for right now, for today. Those are all very good answers, and those are all things that we will be discussing. We will talk about what credit worthiness means. Income is definitely a really interesting answer in terms of the kind of how income and credit works together, and everything you said. So perceptions on credit can be both positive and negative. So that's part of the reason that we asked this, was to kind of get your experiences or your perceptions. One thing that some people will say when we talk about credit is debt. So for many people, credit is a symbol of debt, anxiety, or fear. And we want to make sure that we're kind of shifting the conversation to other ways to think about credit. So, the title of the class is Credit as an Asset. So starting to think about credit as an asset. So again, like rethinking that mindset, shift the mindset from credit as a deficit to credit as an asset. And, remembering that credit and debt are not the same. They are two different things, although they're often coupled together. So just to kind of frame the conversation about credit and debt, we have a little bit of a lesson in our. We have a little bit of a lesson here. So credit comes from creda, which means trust or value and worth. And debt is a sum of money that is owed or due, or something owed. So that's oftentimes when we think about credit, people will start thinking about debt, but you don't have to necessarily go into debt to build your credit. They are not synonymous. So that's an important thing to really note. So why is credit building important? It's important because having good credit can help you gain access, pay less, and improve your options for a number of different things. So that may include financial products. So what kind of accounts you have access to, if you want to get a loan, right? So if you have really bad credit, getting a loan may either be very expensive, not have the best of terms, or be almost impossible. Well, if you have better credit, you're going to have a lot more access and you'll have better terms. Some rental housing will look at credit, utilities, cell phone plans, insurance products, really assets and building wealth, and for some even employment. So that's very specific in terms of employment, but some certain kinds of employers can look at your credit and kind of make a decision about employment based on your credit. So the other thing that we want to look at credit is because good credit can help us manage emergencies, reduce expenses, and achieve our goals. So manage emergencies. Most people don't have enough money to cover a $500 emergency. We definitely want to work on building those emergency savings. But if you don't have them, or if you have a significantly larger emergency and don't have the cash available, having that credit available can really help you manage that. Reducing expenses, like I said, especially when it comes to financial products, you're going to have much better terms if you have better credit. And that translates directly into money, especially because the interest rates are going to be higher, right? Or what you're able to get, it's just the terms are going to be much different, and achieving your goals. So for some of your goals, some of your financial goals, you may need to use credit in order to reach those goals, and having access to those better products, having access to everything will make a difference there for you as well. So next, we're going to talk a little bit about credit reports. The first step in building or rebuilding credit is to understand your current status and to understand how credit is assessed by the financial system. So many people will say we want to automatically discuss credit scores, but it's really important to understand credit reports. So the key terms when it comes to the credit industry include credit history or file, which is how you have used credit in the past. Credit report, which is a summary of your credit history at a moment in time. So the report is compiled by credit reporting bureaus on an individual's history of debt, credit, and borrowing behavior. The difference between credit report and credit history or file is that credit history or file is the entirety of your credit history or file, while a credit report, again, is on a particular point in time. So your credit report will change depending on when you are checking it. And then credit score, which is the 3-digit number that summarizes your credit risk at a moment in time. And the number is based on the analysis of a person's credit report that represents their credit worthiness. So this is kind of like what we were talking about before. So if you want to think about it, your credit report can maybe be like a report card, credit score, maybe like your GPA. So that's kind of another way to kind of think about this and kind of put this into terms that we're all thinking about regularly and kind of understand a little bit better. So in order to understand the credit reports, we need to know who the credit bureaus are. So who are they? There are many credit reporting bureaus, but the big three are TransUnion, Experian, and Equifax. Their job is to gather and organize pertinent information about you and your credit history. Because there are so many credit bureaus, it's important to note that they don't all contain identical information. So if you were to pull a credit report from a TransUnion, Experian, and Equifax today, they would not all have the same things on there. That's why it's important to pull all three. They don't go out and get the information. Creditors provide them the information. Creditors choose which organizations, which credit bureaus they want to give the information to. So that's why you may see that certain loans aren't on one that are on another. It doesn't mean that anyone did anything wrong if the things that are on there are true to your current situation, but they might be different. This is why they say when you're checking your credit reports, you want to check all three, not just one. So what is on your credit report? There are a number of different items. This will look different. So your credit report is going to look, a credit report from Experian, Equifax, and TransUnion may look different, but the core information, the core areas are the same. So one of them is personal identifying information. So you will see your name, date of birth, social security number, current and previous addresses, and employers. Employers will be on there if they were in some way related to you pulling credit, to applying for credit. You want to be pulling your credit reports regularly, and if any of the information is wrong, you want to dispute it. Sometimes you'll see a social security number that is not your social security number. If you are married and you asked for credit or requested credit with your spouse, their information might be on there. However, it's possible that you'll see a social security number that is not yours or a spouse's or anybody else that's on a credit with you. Like, let's say you have a card with your child. Take that out. A completely random credit social security number, that is something where you'd want to get in touch and dispute and make sure it's that either there could have been some kind of error, clerical error, and they put in the wrong number by mistake, but it could also be an identity theft situation. So you want to make sure that you're reaching out and correcting that. For names, you'll see any name that you've ever used. So if you use nicknames or different kinds of names at different points in time, you'll see that. Generally speaking, it's in your best interest to use your full legal name every time that you pull credit, just so that it's complete and you know what you're doing, you know it's you, and not to be using nicknames or different names at different times. So credit history, you will see all the lenders that you've done business with and will contain information about the types of credit accounts, the kinds of payments, outstanding balances, credit limits, date that accounts were open and closed, current status, such as on time or late payments. So all of that will be written out in the credit history section. You'll also see public records. So this section will include any information about bankruptcy filings that you may have. Chapter 13 bankruptcy will remain on the credit report for up to 7 years and 180 days from the filing date, while Chapter 7 will remain on the credit report for up to 10 years from the filing date. One thing to note about this is that there have been some changes. So in the past, you would be able to see public records on credit reports, all different kinds of civil judgments and tax liens, but those should no longer appear on credit reports as of 2018. So if you see those debts on a credit report, you can tell them, hey, take this off because it shouldn't be on here. But if you do actually owe that money, not having it on the credit report doesn't mean you don't owe it. You still owe it. It just means that it shouldn't be on your credit report and should be visible to everyone who pulls your credit report anymore. Inquiries. So this section will show which lenders, employers, and others have requested your report in the last 2 years. It'll also show if your report has been accessed for educational purposes or pre-approvals. One thing people often ask about is, will an inquiry affect my credit score? So if it's for informational or educational purposes, it won't affect your credit score, but it will be on your credit report. If you are requesting the report because you're asking for credit, so a lender is requesting that information, then that will affect your credit score. Either way, it'll be on your report. But again, whether or not affects your score is going to depend on whether it was for the purpose of obtaining credit or whether it was just educational and informational purposes on your own. So consumer access to credit reports. Have any of you ever heard of annualcreditreport.com? Yes. I see Laurel shaking her head. Yes. And Ashley, okay. So annualcreditreport.com is a great place. This is government run, so you don't have to be worried about whether or not this is real or not real, or if they're going to end up charging you money or not charging you money. You get one free report each year from the 3 major credit bureaus. Right now, you get free weekly reports. That's going to stop. But right now, because of COVID, you're still getting free weekly reports if you wanted to pull those. Maryland law also allows for a free credit report per year. And then there's also something else called an adverse action. So if you're denied for credit or favorable terms, then they should give you, you can ask for a credit report. So these are kind of like some of the ways that you can do it for free. In terms of accessibility, if you are deaf or hard of hearing, you can access a TDD service by calling 711 and referring the relay operator to a phone number, which is 1-800-821-7232. We'll be sharing these slides with you, so you'll have this information as well. If you are blind according to the ADA, so it has to be according to the ADA, you can ask for a free annual credit report in Braille, large print, or audio format. And what you'll need to do is call their toll-free number, which is 877-322-8228. You'll have to provide personal information to validate your identity. So they'll probably ask you a lot of different questions related to, depending on how old you are, you may or may not have been alive, but in 1984, what street did you live on? Or if you ever had a student loan, they might ask you, did you have a student loan from this college on this date? They're going to ask these very specific questions because they want to know that you are who you are. It could be any number of questions, but those are examples. They'll need you to provide additional information to certify that you're blind. You get to pick the format that you want. So you can tell them if you want Braille, large print, or audio, and then they'll send it to you. So if you do it on annualcreditreport.com, it's pretty fast. You get it right away. If you're getting it in Braille, large print, or audio, it's going to take about 3 weeks. So that's something you need to be aware of. It's not going to happen right away, but you'll be able to get it in a couple of weeks. So again, just to kind of go over your rights, you will receive one free copy of your credit report from each consumer reporting agency each year, which we talked about. You'll be informed if you're declined for a loan or receive unfavorable terms because of negative information. You can dispute information if you believe it to be incorrect with the credit bureaus and or the original furnisher. So you can tell the credit bureaus. On the online format, they actually have a little button to press to dispute. So if you're looking at it in Braille or in audio, you won't necessarily be able to do that, but you can talk to them about disputing anything that might be incorrect. And you can receive a free copy if you dispute something successfully. So if you dispute it and they say, okay, you're right, this shouldn't be this way, then they should also give you a free copy once they've already changed that. So you just want to make sure that you're very clear on your rights when it comes to the credit reports. All right, so now that we kind of have an idea of what the credit reports are and why they're important, we want to get into the nitty-gritty and talk a little bit about credit scores and how those will affect you as well. So what do you all believe, what kind of information do you think makes up a credit score?
Salary,
Salary, okay. Your
payment
debt,
history,
payment history,
like you said, debt.
okay, very good. So the same information that is used in credit reports is going to be used to make up your credit score. And that's going to help, like I said, you know how we had the report card and then the GPA. So it's the same info. So we'll get into that in a second. I thought it was the next slide. I apologize. So with the credit scores, there are as many credit scores as there are credit reports. Different businesses pull different reports to assess different types of risk. So like we said, generally, like if you're thinking of your generalized credit report, it's TransUnion, Equifax, and TransUnion. TransUnion, Equifax, and Experian. But there are many others. So if you're trying to get a car loan or a house loan, they're going to pull a report that's specific for housing, right? And then they're going to pull a credit score that's specific for housing. So that kind of happens the same way. But generally speaking, when we're thinking about like the most general terms, we have, most people have heard of our FICO and Vantage scores. FICO creates the most widely used credit scores in the lending industry. And Vantage was created jointly by the three major credit bureaus in 2006 in order to design a consumer-friendly credit score. And most free credit score platforms provide Vantage scores. So if you've ever gotten your credit score for free, it was probably a Vantage score. So now we're going to go to the next part to answer the first question we had here. So the 5 principal factors that influence your credit score are payment history, amount owed. So we're talking about debt. So like the amount of debt, but this is specific to what you have available. So the amount owed or the utilization rate. So how much you owe compared to how much credit you have total. The length of credit history, new credit, which would mean like how many new cards or loans you have, and the credit mix. So is it revolving or installment credit? So someone had said salary, and that was a really good guess. And it's an important guess because it helps us remember that they're looking specifically at your use of credit. So your salary is telling you how much you're earning, but it's not telling you how much credit you've used. And they also can't put things like politics, your gender, like none of that can be influenced here. It's strictly looking at how you've used credit, if you've used credit before, and how you're using it basically. So it's very focused on those things. All right, so in terms of the factor that has the strongest influence on your credit score, it's your payment history. So although everything else is important, Payment history is about 35%. So that's like a very significant impact. So that's why they say if you have good credit, it's easy to get bad credit. Because if you don't pay something on time, it can have a really big impact. If you have a good score, it'll have less of an impact if you have a lower score. But making sure that you're making those payments on time every single month is going to have a really significant impact on your credit score. So when it comes to the range, so we're kind of saying like higher credit scores or lower credit scores. What score range are you currently in? So the FICO credit scores, which is the most common, go from 300, which is on the lower end, to 850, which is on the higher end. The lower the score, the higher the interest rate and the fewer options you have for financial products. The higher the score, the lower the interest rate and the more options you have. So it directly impacts what products you'll have available to you. If you have poor, quote unquote, poor credit, deep subprime would be like below 580 and subprime is 580 to 610. You're going to be viewed by lenders as a high risk. You may be denied for credit completely, or loans and credit are approved, but they'll carry really high interest rates. If you have what they consider quote unquote fair credit, which is near prime, which be credit scores of 620 to 659, might be eligible for reasonable or good rates and terms, but for some things you might need a co-signer or a deposit might be required. So they may need some kind of collateral. Good to excellent credit, so prime 660 to 719 and super prime, which is 720 or above, you'll be eligible for very good, really the best rates and terms on any kind of financial products. And you'll be viewed by lenders as dependable and low risk. And that's what it is, right? So they're looking to see how dependable and how risky you are. The lower your score, they see you as less dependable and more risky. The higher the score, more dependable and less risky. So there are some people that do not have a credit score. You might not have a credit score at all if you have never used credit cards or loans before. If you only started using credit recently, so if you hadn't really used it and you just started 3 months ago, you're not going to have a credit score yet. Or if you've used credit in the past, but you don't have any accounts with recent activity. So you have a history, you know, what we talked before about the credit file or history, credit report and credit score. You may have a credit history if you used credit 10, 15, 20 years ago. But if you haven't used anything since then, you may not have any recent activity. And so you won't have a credit score. I'm going to go back. So the good thing about not having a credit score is that there's nowhere to go but up. So if you start using credit wisely, you can very quickly build a really good higher credit score. It's often easier to start from scratch than to try to repair. So not all is lost if you don't have a credit score. There's still a lot of options for you in terms of building it. You just have to build it responsibly. So going back to some of what we discussed before in terms of the scoring factors. So payment history would be the #1 impact. So at least for FICO, payment history is 35%. So this is paying on time or late or not paying. Amount owned or utilization is 30%. So that's not far behind. And this is the amount of credit used compared to the total credit. So let's say you have $1,000 and you're spending 500, that's a 50% utilization rate. If you're only spending 10, that's significantly lower, right? So like what percentage of what you have available are you using? The length of credit history, that's the amount of time you've had credit accounts. So sometimes when people are trying to repair their credit, they'll say, I'm going to get rid of every single card. And that may be the best thing for them. For some people, keeping the oldest card and paying it off and just using it to pay a bill they're going to pay every month might be better. We can't tell you what you should and shouldn't do, But that length of credit history is something that is going to be important in terms of developing that score. And that's about 15%. New credit, so we talked about that. How much new credit have you opened recently, whether that's a credit card or a loan? And then credit mix refers to the different kinds of accounts. So they could be credit accounts, car loans, mortgages. So the key thing to remember here is revolving versus installment credit. So revolving credit is like an open line of credit, like a credit card, where they say you have a certain amount of money. Let's say they tell you $1,000. And for that revolving credit, you can use up to that 1,000 and never expires as long as you keep the account open. But for an installment credit, it's very different. Let's say you have a car loan where you're paying a fixed amount for a certain number of months for a fixed amount of time, and then you've paid off that loan. So that's the difference there. So it's going to be looking at the mix, how much revolving, how much installment, and different kinds of credit that you may have. So the more diversity you have, the higher that credit mix score is going to be. So here's some best practices for strong credit scores. So you want to keep it active. You want to establish and maintain a mix of active installment and revolving credit accounts and always pay on time. So keeping it active is to keep using it. So one keyword here or keywords here are 6 months. You want to make sure that you're using it at least once every 6 months to keep it active. You want to keep it low. So the lower the debt balances on revolving lines of credit, so revolving, those that have a credit line that you can use a certain amount of, the lower the balances, the lower the percentage, the better off you're going to be. And you want to keep it up. So again, you want to have at least 6 months of credit history and activity on your credit report at any time. So next, we're going to talk a little bit about, first, are there any questions before I go forward? I know I've kind of run through a lot of information. All right, perfect. So now that we have a good understanding of why credit is important, how to make sense of credit reports, which is also incredibly important, and what credit scores are and how we figure out our credit score, what goes into the credit score, we can begin to focus more on moving from theory to action and how to actually build that strong credit. So what do you think are the most important things you can do to build your credit? Don't spend too much. Very good. Kind of a trick because I kind of gave you the answer a couple slides ago. Okay, so
Pay
establishing
bills
it.
on time.
Yes, exactly. Thank you. Paying your bills on time, not spending too much. Very, very good. So yeah, establishing and maintaining a mix. So again, ideally at least 3 different types of active credit lines that are used regularly, paid on time. If you have 1 or more revolving credit products in the mix, focusing on keeping those balances low. So exactly what you said, Ashley, not spending too much, keeping those balances low. And this isn't gonna, building credit, just like almost anything, doesn't usually just happen overnight. It might take some time, but it is something that is very doable, and something that all of us can do. So again, on-time payments. You want to make sure that the payments you're making are reported to at least one of the credit bureaus and that this is done every month. These are kind of like the principles of building credit. So you want to make sure that these things are being reported. The good thing is that when it comes to credit cards or loans, those are almost always reported. So it's not really an issue for most of us. But you want to make sure that what you're doing is reported on time each month. So in terms of strategies for building credit, we're going to talk about a couple of different options in terms of credit products that can be used. And so we're going to talk about this for the next couple of slides, just to give you some additional information. And these are different products that you can use to build your credit. So the first thing we have is a secured credit card. So this is a bank credit card that is backed by money, sometimes dollar for dollar to the limit that you deposit and then keep in a credit account. So basically the money that you have in the account serves as a security for the card. So if you don't pay your bill, the deposit that you have in the bank account will be used to cover the debt. Typically, these cards report to all 3 credit bureaus. So that is definitely something that should happen. They're often starter products. They're often used by individuals who either aren't eligible for unsecured cards for some reason, or are just starting to use credit, and it's seen as a safe way to kind of build your credit. Often you'll also see them, often given by banks, but also a lot of credit unions will have those secured cards. So next we have the unsecured credit card, and this is what we usually think of when we think of a credit card. It's a type of revolving account that does not require collateral, no money down, no money in an account to back it up, that can be used to make purchases on goods and services and can be repaid over time. So again, this is the kind of card that most of us are familiar with. The lender charges interest on the amount borrowed unless the cardholder pays the balance in full at the end of the month. And typically these cards report to all 3 credit bureaus. So you can be using one of these cards and not have any debt as long as you pay it off at the end of the month. Then we have authorized user. So an authorized user is a person who has permission to use and or carry another person's credit card, but isn't legally responsible for paying the bill. So if you're an authorized user on somebody else's card, you may be able to use the card. You're not responsible for paying the bill. I mean, you can negotiate what you want, but legally you're not responsible for paying the bill. And you will be able to get the credit that the actual user has. So sometimes you'll see people I've met people who are in their early 20s who have really good credit and have a credit history going back 10 years. Their parents set them up as an authorized user on their account, on their credit card. They never gave them the credit card. The kids never had access to it, but their name was down. So they built really good credit. They piggybacked off of their parents' credit and built credit without even doing anything, really. So that's a strategy that some people will use. Obviously, you want to be careful if you're ever putting anybody on your credit card and then giving them access, because then they can spend the money. But there are ways to use the authorized user to help someone piggyback off of your good credit if you have good credit. We have personal loans. So a personal loan is an installment loan where money is borrowed from a financial institution and it's typically paid back in installments. So it's a certain amount over a certain amount of time until you have completed paying off the loan. We have student loans. Student loans also report to the credit bureaus and will generate activity when they are not in deferment or forbearance. We also have a credit builder loan. A credit builder loan is an installment loan that's most commonly offered by credit unions and nonprofit financial institutions for the sole purpose of helping to build credit. You have social loans or lending circles. So I don't know if you all have ever heard of this, where certain communities will sometimes all put money, all kind of chip in money together and kind of lend money around each other. Oftentimes those things aren't something that's going to be on a credit report, but it can be. So it can be linked with credit building if the loans report to at least one of the credit bureau. Then we have rent reporting. So rent reporting is the regular monthly reporting of tenant rent payment to at least one of the major credit bureaus for inclusion on a consumer credit report. That's usually done by your rental agency. You can look into it on your own as well. But if you are paying your rent on time every month, this is a good option for you in terms of trying to build that credit. So I have a couple questions for you now. So we're gonna do a little game called Will This Help Me Build Credit? There are 4 questions. So first question. Will having an open credit card that you haven't used in a year help you build your credit? Yes or no? You can put your answer in the chat or say it out loud. Will having an open credit card that you haven't used in a year help you build your credit?
I think this is a trick question.
Why?
Thinking yes, because you haven't closed an account, but no, if nothing's being reported, it wouldn't help. So I don't know.
You're almost there. So we'll go forward and say, no, you were right. You were right on the button. You were exactly right. So it's no, because it's inactive. So if you haven't made a payment in 6 months, there's no activity. So it's open and you have it, but it's not active. So you're not actively building credit if you haven't used it. So this can be good. Like if you don't want to spend a lot, if you don't want to do this too much, you can just say, okay, I'm putting my one bill that I pay every month that I know I'm going to pay, like I always pay on your credit card, and pay it off that month and have it set automatically, and then it'll help you build credit. So you were right on the second part, which is that it doesn't, because it's not active. It needs to be at least once every 6 months. All right, number 2. You have a car loan that is in good standing with a $2,000 balance. Is that going to help you build your credit?
Yes.
Okay, we have a yes, we have a yes. And yes, you are both right. So this is going to help you because it's active. You're paying every month, so it's active. And you are paying the amount that is owed, right? So for a car loan, that's an installment loan, so it's a fixed amount, and you're paying that fixed amount. So this will help you build your credit. All right, you have a car loan that was paid off last month. So again, the question is, will this help you build your credit?
Well, yes, in that you paid it off one time, I'm assuming, but no, in that you're done. So there'll be no more reporting history.
Okay, very good. Any other thoughts? Very good, Janice. Thank you. So the answer is no. So this is exactly what you said at the end, Janice, which is that there is no more payment. So if you have a mortgage or a car loan and you have paid it off completely, it is no longer active. So it's still on your credit report for a certain amount of time, and we'll talk about that in a little bit. So it still looks positive as long as it's still on the report because it looks like you paid it off. But it's not helping build your credit and increase your credit score or anything with your credit score because it has been paid off. So it's no longer an active trade line. All right. And the last one, this is hard. Okay. So how about a collection account that you're making payments on? Is that going to help you build your credit?
I'm going to say no.
All right. Thank you, Janice. Okay, and Lee said no. And you are both correct. So it's inactive. So any kind of collection account can never be an active credit. And that's except for student loans. So student loan collections can actually come back into a positive active trade line if you are placed into a repayment plan. But anything else can't do that. So if it's in collections, it's not, if you're paying it or not paying it, it's going to be inactive and it's not going to have that. Basically, while it's in connections, it's just going to be negative until it's gone. And, you know, it's still going to have a negative impact, but you still owe that debt. So it's still positive for you to not owe the debt, but it's not going to help you build credit to be paying off or not paying off your collection accounts. So here's we'll go through this scenario very quickly. So this is, can I build credit without going into debt, and kind of talking about what we talked about before. And here we have an example of credit building without building debt. And this is Sophia. So Sophia had not used credit in many years and had a credit score of 550. She opened a secured credit card with a major credit card company, connected it to auto pay her music streaming services. So we talked about that, like connecting your bank account, paying for one specific thing every single month. Then she set up her bank account to auto pay her credit card bill in full each month, which means she didn't owe anything. She wasn't paying interest on anything. She didn't have any debt with them. After 6 months, her score increased to 660, and she was eligible for an unsecured credit card because her credit had gone up. And she wanted to be sure to continue to avoid getting into debt, so she only used her card for transportation costs. She always paid on time and in full, which allowed her to continue to build her credit. So it is possible. In a separate class, someone actually asked me if paying off your card in full made it so that you no longer were building credit. They thought that meant that it wasn't active, but it is active because as long as you're making that payment, it's active. So it is possible to build credit and not go into debt. So here are some ways to successfully manage your credit accounts. So for installment loans, so those are the loans we talked about, right? So that would be like a car loan, a house loan, anything where there's a fixed amount for a fixed amount of time and then the loan is paid off. You want to ensure that extra payments are allocated correctly to principal and interest. So if you're able to make extra payments, you may be making extra payments and thinking it's paying this off more. You want to make sure to talk to the people, look at your contract, but talk to the person who has your loan and see if you can pay some of it towards principal. But then also look at how it's divided between principal and interest. You want to talk about fee payment, if that may reduce overall costs. And you want to understand that closed loans will no longer build credit, right? So once you finish paying it off, you're done. One thing that's important for these things is also to really think about your contract. So for some things, for example, for houses, some mortgages will say, yeah, you can pay a certain extra amount each month, and then it'll just cut down and make it so you pay off your house or car, whatever, much faster. But you want to know what the terms are. So there are some mortgages that will say, if you do that, we'll charge you a certain amount of money. So you want to make sure that you know, if you pay off your house in full today, we're going to charge you this much money because you've prevented us from charging you interest, which we agreed upon when we first got this mortgage. So you want to make sure that you're understanding your contracts. For revolving credit, if possible, pay the full balance each month. You don't have to pay interest if you do that. And then you're borrowing money in essence for free, because that's what credit is. It's borrowing money. If you're not paying, the interest is the cost of borrowing the money. You want to keep balances low, avoid the minimum payment trap. So if you see now they pass certain laws where they have to tell you how long it'll take you to pay something off if you only pay the minimum balance and how much it'll be. Why bother getting a shirt for $15 on sale if you're only paying the minimum amounts and in the end the shirt cost you $300, right? Because of all the interest that you paid on your credit card for buying the shirt. So you want to kind of be aware of that, of the interest. And keep revolving accounts open unless there's a strong reason to close them. So if they have high annual fees, high interest, if they're just not a good fit for you, otherwise you want to keep them, you want to think about keeping them open and, maybe not buying a lot in them, paying them off in full. As we said, the whole thing about having a mix, but also about having the oldest credit accounts open. Again, this is going to be very specific to each person. So this is not a blanket. This is what you should do in every situation. You need to be aware of your particular situation. But these are some kind of common ways to successfully manage. You want to assess your credit readiness. So why do you need credit? Do you understand the terms? Are you just getting it because you got something in the mail telling you that you should? Have we gotten so many ads that now you think that you should do it? Did you see somebody buy something? Social media is horrible for this, but you start thinking you need things you don't need. You want things you didn't want, right? So why are you doing this? What is the reason? Affordability. What can you actually afford? How will this impact your financial stability? Are you going to be are you not able to pay things in full right now? If this has a really high interest rate, this is maybe not that affordable for you. So you want to really think about that. Are you in a position to be successful? Are you in a space where you're going to be able to responsibly pay off the credit? And how will a new loan impact your credit profile? Have you asked for a bunch of different credit cards and loans over the course of the last 5 months? And this is just another one, and it's going to impact your credit score. Like, you want to think about all of those things. We don't have a lot of time and we have a lot to cover on debt. So I'm going to go over a little bit of this. I'm going to be skipping around a little bit, but I will be sharing the entire slide deck. So you will have all of this information, but I will try to kind of go through this a little bit quickly. Did anybody have any questions about the parts we already discussed? High annual fee and high interest rate for credit cards. What numbers are recommended? So I could get back to you with that information, because I don't know that off the top of, I have an idea, but I don't have it off the top of my head, and I don't want to tell you, something that's not correct. So I will look that up and get back to you when I send the slides. All right, so dealing with debt. When it comes to debt and credit building, making decisions about debt with credit building in mind is really important. You want to tackle any low-hanging fruit, prioritize and navigate any kind of competing priorities you may have. So when it comes to debt, credit building, and low-hanging fruit, you want to dispute any errors or inaccuracies on your credit reports. That's generally easier to do. It can really help you if there are things that are wrong. You'd be shocked, and I'm always shocked when I see people's credit reports and there are things on there that should not be on there. So you'll often find errors and inaccuracies, and that's something you can address pretty easily. Catch up on past due accounts. So if you have accounts that are late, you want to make sure that you're getting to those first. Reduce balances. So every little bit counts, every little bit helps. As much as you can reduce your balances is going to make a difference. Prioritizing, you want to keep current accounts current. So if you have accounts that you're using right now, you want to keep them current. You want to keep them active. You want to prevent further harm. So you want to work with what you have. Some people sometimes feel overwhelmed and say, I'm just going to open a new card and start over. You still have the old cards. So they don't go away because you open something new. And you want to consider the size of debts and interest costs. And again, I'll look into that, get back to you all with those numbers, but you want to consider the size of debts and interest costs. When it comes to navigating competing priorities, you want to bring older accounts current instead of opening new credit accounts, like I just said, whenever possible. Keep older revolving accounts open and active because of that credit history, right? Like how long you've had this open. Balance credit building while addressing collection accounts. So that's something that might be difficult if you're in a process where you have a lot of accounts in collections. And this might be something where you want some additional help to know how to navigate that. And we'll talk about that in a little bit. When does information fall off your credit report? This is important to note. Again, I'll share the slides with you all, but this is really important because this way you can kind of, when you're looking at your credit reports, you can see if there's some of this that you can get taken off that shouldn't be on there anymore. So open accounts in good standing. So you're paying on time, you're doing well, and it's open. It's on there indefinitely. As long as it's open and in good standing, it's going to be on your credit report. Closed accounts in good standing, 10 years. So remember how we talked about that car that had been paid off? that card that had been paid off, it might not be helping you build your credit, but it's going to be on that credit report. So if anyone looks at your credit report, it's going to be on that credit report for 10 years. After 10 years, it'll fall off. But for those 10 years, it's going to it makes a difference. Date of missed payments, 7 years from the date of first delinquency. So this is what I was saying about paying things on time, even just paying the minimum. Just pay the minimum every month if you can't do anything else to begin with. Not paying the minimum on time will affect you, and it'll be on your credit report for 7 years. Just one time. So you know, if that's something that's happened in the past, it's okay. You can address it, fix it, move on. But going forward, really try to make sure that you don't have those missed payments. Charge off collections, 7 years from the date of first delinquency. Bankruptcy, like we said, 10 years for Chapter 7, 7 years for Chapter 13 from the date of entry. Foreclosure, 7 years, and inquiries, 2 years. So I'm going to just go, you all can answer if you want, but I might just power through this. So which approach to debt reduction will generally save you the most money? A, paying the lowest balance off first, which is called a debt snowball. Paying the highest interest rate first, which is a debt avalanche. Paying the same amount on all your debts, so minimum payment plus $10, for example. Paying minimum balances on all your accounts, or it doesn't matter.
Highest interest.
Highest interest. Very good. So yes, generally speaking, paying the highest interest first is going to help you. The reason to do the one that we mentioned just before that, which was paying the lowest balance, is motivation. So some people feel so overwhelmed by the amount of debt that they have that just feeling like they're going down on the one that has the most interest doesn't make them emotionally, doesn't motivate them as much as paying something off and being done with something. So paying the highest interest is financially the best in terms of saving you money. But if you know yourself and you know that you need that added motivation from having something done, and that's going to make it so that you continue paying things and continue paying down your debt, then that's also a good option. But yes, generally speaking, paying the highest interest rate first is going to save you the most money. So you want to, in terms of paying off your debt, you want the steps to that debt avalanche are assessing your budget, inventorying your debts, making a plan and paying more than the minimum, applying surplus money to high priority debts, and paying debts one by one. So once you've paid off a debt, you no longer have to pay those $50 a month to that debt. That money should not move into spending. That money should just automatically move to a different debt. And that way you'll just continue to pay it off. So those are some strategies. There are a number of different websites and apps that you can use to manage your debt. Powerpay.org is one of them that a lot of people like. And again, this will be included in the slide deck. Collections, the impact of collections on credit scores. The greatest impact is at the beginning, and then it's lessened over time. But it takes a long time to have lessened impact from collections on your credit report and on your credit scores. Usually after the 24-month mark, it'll start to go down. Again, I'll have this information, the slide deck for you all. So how much time do we have, Ashley?
You're good to continue.
I'm good to continue? Okay. All right. So in terms of strategies for paying collections, a couple strategies. So we have paying in full. This is the most beneficial for your credit score because once it's gone, it'll be out. So that's going to be the most beneficial, like on your credit report, it won't be there anymore. But it does cost more money, and that's upfront cost, right? So upfront cost, it is going to cost more money because you're paying all of that at the same time. Settling generally costs less money because you're settling. So you're agreeing to, you're making an agreement to pay a less amount of money. You should know that any money that is forgiven you're not free and clear. Any money that is forgiven from a debt payment is counted as income for taxes. So that money is not just, I settled out of this, now you have to pay income taxes on that money. So you will still have to pay something on that money. And then payment plans. So payment plan can be something that's really useful for some people. You just want to make sure that you're really clear on the arrangement. You want to be really clear on like if the payment plan makes sense for you. For all of these things, you want to be clear that the statute of limitations hasn't run out, right? So you want to make sure that you're still really owe the money legally. So this is also an area where you might want to get some assistance, and be really careful with credit repair. So anybody who's going to tell you, make you promises, say your credit score is going to go up this many points in a specific amount of time, this is going to happen. You know, anyone who wants to charge you up front for the services, who doesn't inform you of your rights before you're starting, anyone who asks you to misrepresent information to the credit bureaus, you just want to be very careful. If you want help with credit repair, there are nonprofit agencies that could help you with debt management. You want to be careful and aware of, the potential issues you might have with for-profit agencies who are trying to do this work. And making credit building count. So again, the fundamental principles here are making on-time payments, which are reported to at least one of the credit bureaus every month. You want to establish and improve your credit history. You want to the outcomes for improving credit. So as you get better credit, you'll have established and improved credit history. You'll have access to affordable products and opportunities. You'll have increased savings and financial stability, and eventually you'll get to the point of financial security. So in terms of additional support, we have a Trust Plus coaching program through Cash Campaign. They can help you with spending plans, managing credit and debt to a certain point. So if you need help with like pulling those reports, having someone talk you through them, kind of looking at how all of these things play out together, you can work with a coach. You'll text Cash Coach to a phone number 646-349-5959, and then you'll get a link to a Trust Plus service. So with that link on your phone, you have to have a phone that can get an email where you can connect to the link to the website. You have to have a phone number and an email address, and then you can get connected. If you're not able to do that due to different issues that you may have, this might be a time to get either a trusted family member or someone else that you're working with to help you to make sure that you're able to access the service. Once you've filled out the registration information, you choose the coach you want to work with, and then everything is either by phone or by video call. So if you need help setting it up, once it's set up and you have that first appointment, after that, you can just do everything by phone. So you can just talk to them and tell them when you want to do the appointment or, et cetera, and just speak with them on the phone or in the video call. And this is free, unlimited one-on-one coaching. So there isn't like a time frame when you'll be cut off. And that is it for today. So does anyone have any questions they have for me or anything else that I could kind of expand on for you all? I know I covered a ton of material.
I think you did a very good job. Thank you.
Thank you so much. So if any of you have any questions for me, you can email me. My email is christina@cashmd.org, and I'll add that information to the chat so that you have that. And I do apologize for running through at the end. I just wanted to make sure that we got through everything. All right. Well, thank you all so much for your time. And thank you for your participation. Thank you for everything. And again, feel free to reach out to me if you have any questions. I'll be sending Ashley the PowerPoint so that you all can review it at your leisure. And I'll also get that. Like I said, I have an idea of my answer, but I want to look it up and make sure I'm right before I tell you anything in terms of the percentages for credit cards, for the interest rate for credit cards.
Thank you. It was very informative. I appreciate it.
Thank you so much. All right, Ashley, I'll leave it to you.
All right, everyone. Well, thank you so much for coming again. Thank you, Christina, for doing such a fabulous job. This program was recorded. It will be made available on YouTube in the next by the end of next week, if not sooner. So thank you all so much for being here tonight, and have a great evening.
Thank you.
Thank you.